Wonderful good day, ladies and gentlemen. I'm your host today, Jochen Staiger, Chief Editor of Commodity-TV, here in partnership with Dukascopy-TV. And we want to talk about mining in Zimbabwe, in Africa. And with me here is Mark Learmonts. He's the CFO of Caledonia Mining. Mark, very warm welcome.
Thank you.
Mining in Zimbabwe, very interesting. I even thought it's not possible, but I'm sure you have a fantastic business going on there. You pay dividends, you make money. Please elaborate a little bit on your business.
Yeah, one of the frustrations we have as a listed company is addressing people's preconceptions about how difficult it is to do business in Zimbabwe. We bought this mine, the Blanket Mine. We bought it off Kinross in 2006 as they focused their attentions elsewhere. And yeah, we've had difficulties. There were difficulties in 2008, early 2009 with inflation. We had difficulties in 2011, 12 relating to indigenization. But we've seen our way through those issues now. And over the last sort of 5-6 years or so, we've demonstrated that we could actually develop a decent business in Zimbabwe. We've increased production from about 2,500 ounces a quarter up to a peak of about 12,500 ounces a quarter. Okay, it's come down slightly, but we've got a plan to address that.
But you're still at 10,000 a quarter, right?
Yeah, we're about 40,000 ounces a year, but we have actually got a plan to grow the business, which I think we'll come back to in a moment. Yes. But let's just look at where we've come from. So we've demonstrated we can grow the business in Zimbabwe. We've demonstrated that we can bring the costs down. We're a relatively low-cost producer. In 2014, our all-in sustaining cost was about $950 an ounce. So, you know, we're not the lowest cost producer in the world, but we're on the low end.
But you make a nice amount of money.
We do, but we do generate cash. And so even at the relatively lower gold price now, we generate cash every single day, which I think is important. So one of the things we try and stress to investors and prospective investors is that actually we've demonstrated that we can operate successfully in Zimbabwe. We can grow the business, and it's an environment that we're very comfortable in. And you know, as evidence of that degree of comfort, we announced late last year that we're going to be investing a further $70 million to increase production from 40,000 ounces up to 80,000 ounces.
So that's a double.
Doubling production, and significantly, it's not just doubling production that will really drive these costs down. So currently, our all-in sustaining cost is about $950. By the time we've implemented this project, our all-in sustaining cost will be down in the mid 750s, perhaps even less than 750. Which means that if the gold price stays where it is, we'll generate even more cash. And if the gold price, if anything happened to the gold price and the gold price fell, you know, we've established ourselves as one of Africa's lowest cost producers, which puts us in a great position to withstand any adverse downside shocks. Or if the gold price stays where it is, we will generate the money, and we can look for other investment opportunities.
Fantastic. As you're running an underground mine, of course, and you said you want to double the production. Now here we see, by the way, some of your workers working underground. How deep is that, by the way?
Yeah, they're working at 750 meters below surface.
So that's decent, right?
Which a lot of people think that's very deep. Actually, you know, we live in South Africa. We used to South African mines which operate at depths of 2,000, 3,000 meters. So operating at 750 meters isn't particularly challenging. And the mine actually isn't a very challenging mine. It's not very hot. It's not very wet. And so these guys they work very efficiently at depths of 750 meters. You might think it looks somewhat tatty, but actually it's fit for purpose. It's a tried, trusted, proven technology. It works, it's robust, and we wouldn't be able to achieve the sorts of results that we achieve if we were using equipment that just wasn't properly maintained or broke down all the time.
Fantastic. As we see here, a picture, I think that's also from your satellite deposits and where you start with new developments.
This is the commencement of work in February this year on the new central shaft. So as I've mentioned to you, we've got a plan to invest $70 million to double production from 40,000 to 80,000 ounces. A key component of that plan is sinking a new central shaft, which will go from surface all the way down from surface to just below 1 kilometre. And what you saw there was the initial terracing work, clearing a huge area of bush. And then what you see here is the start of the sinking work on the new shaft. So those are workers just clearing away the surface rock so that we can put in place the collar. The collar, it'll be about sort of 20 meters by 20 meters by 10 meters of concrete, and that's where that will be the foundation on which we'll put the headgear. And then the work on that collar is well advanced. We'll be filling it with concrete very shortly, and then we can start the long business of digging a hole from surface down to below a kilometre.
1 kilometre down vertical?
Down vertically, 1 kilometre, in a single sink.
Wow,
yeah.
perfect. What would that cost to build a shaft?
Ordinarily that would be quite a significant undertaking. We're spending about $23 million on that shaft, which in the ordinary course, which is probably about a third of a similar shaft elsewhere in the world. And the reason why it's so cheap is that the rock itself is highly competent. So once we've got down below about 70 metres, we don't need to line the shaft with concrete. None of the shafts are blanket miner lined with concrete because the rock is so competent. And also we're using our own workforce, which is highly efficient, very skilled, and is significantly cheaper than the use of imported contract labour from other jurisdictions.
Fantastic. One last word, let's say, on the outlook. We assume, of course, you do everything you said. Well, I'm pretty confident. And you are already paying a dividend. You have a 6% yield now on the stock, which I really like because I'm one of your shareholders too, because I love the dividend. Maybe can you give us in 2-3 sentences a little bit of a projection what you will do then when you have doubled the production, you earn a lot of money, you brought your costs down, let's assume below the 800 at least, and you will earn hopefully an awful lot of cash. What will you do?
As you know, we currently pay a dividend, 6 cents a year, split into quarterly dividends of 1.5 cents a quarter, and we've been paying that for some time now. We've given guidance that we'll continue that dividend payment into 2015. In the next month or so, I expect that we will extend guidance out for 2016. And I'm almost certain that guidance will confirm that we'll continue to pay 6 cents a share for 2016. But you're quite right. As we implement this project, our profit generation, our cash generation increases significantly, and we will then have the opportunity to consider what to do with that cash. And that'll be a combination of either increasing dividend payback, perhaps buying shares back, and also if the right opportunities come along, investing more aggressively for future growth.
Or doing all together at the same time.
Or do any combination of those three.
Exactly.
It puts us in a very good position.
Fantastic. Great. Mark, thank you very much. All the best for that. And we look forward to report positive news from your development then.
Good. Thank you, Jochen.
Thank you very much. Yeah, ladies and gentlemen, that was Mark Learmonth, the CFO of Caledonia Mining. Well, you heard it. It's a 6% dividend yield by now. The company is very profitable. $950 roundabout is all in sustaining costs by now. They want to bring it down well below the $800. And even with gold prices now like between $1170 and $1200, they will earn and still earn, of course, a very awful lot of money. And raising dividends, buying maybe new opportunities, and a combination out of that, that's the future. So in a 0% interest world, I find it very interesting. Thanks. Bye-bye from Geneva. That was Commodity TV in partnership with Dukascopy-TV.